Hello. This is Joseph Mecha Financial Group. Happy New Year, everyone. Happy New Year, and thank God we are made it safely to 2022. The last 2 years have been very challenging with the the COVID-19 pandemic, but we thank God that He has kept us safe and we have crossed to see this year 2022. It's going to be a great year. And as usual, I'm going to be talking about a very interesting subject. I know a lot of us went through challenges, a lot of families went through financial challenges in these past 2 years. A lot of you tried to access funding, tried to borrow money. Some of you are in debt. Some of you are wondering, some of you may have lost your jobs and you're wondering what is the next stage? What's the next move? What are we going to do next to survive? But first and foremost, we want to thank the good Lord that He has made us safe. We're here and we just have to keep on praising Him. But I'm going to talk about a very interesting subject that most of you have been calling, especially my clients, and you want to understand more about life insurance loans. So I'm going to talk about life insurance loans and how do they work. So really, with life insurance loans, if you're in need of money for an emergency, really one of the places to look into is your life insurance policy. But it's not any kind of life insurance policy. That has to be a permanent life insurance policy. And really, the permanent life insurance policies, they are kind of like traditional whole life or universal whole life. So if you have a plan like that, either it could be indexed, universal life, or general fixed universal life, or traditional whole life, you can actually access an insurance loan from those kinds of policies. Unlike term life insurance policies, which has a set limit on coverage and does not accumulate cash value. So even for the permanent, that's the whole life or the indexed or universal life policies, the living benefits policies, the first policy years, the premium that you're really paying goes towards funding the indemnity part of that life insurance policy. But if you have that policy long enough, let's say 5, 6, 7, 10 years down the road, you can actually start using it to borrow money from that plan. So it's very important that you understand. It's not, having a life insurance policy is not a get rich quick scheme. Now, there are instances where you can immediately start utilizing a life insurance policy to access, loans from it, especially if you did what we call a single premium paid up life insurance policy. It is possible, you can structure that kind of plan where instead of you having cash sitting in a savings account and earning little or no interest at all, but at the same time you're not protected. For example, if you have, let's say, $200,000, I did a case in the state of Ohio for a client of mine, and they had like $200,000 sitting in a savings account, and it was earning nothing for them. But God forbid anything happened, all that would go to their two grandkids was that 200,000 less whatever taxes, or the debt tax and all that. So we were able to open a single premium policy, and this client was able to get an $800,000 policy. But after 30 days, they were actually of policy establishment. They were able to go back into that policy and start utilizing the lump sum down payment that they put into that policy, and in the form of loans. Now the beauty of that is, life insurance loans, you don't have to pay them back, yeah. And if you did, the money still goes back into your policy account. So therefore, borrowing from your life insurance policy is a good option, instead of you trying to utilize bank loans or high interest credit cards. So it's far much more convenient, since paying back that loan is optional. So the way it works is, for you to start accessing that cash, first you have to have accumulated cash value in the policy, okay? And that cash value that you have accumulated, if you are contributing monthly or annually, it will take time for that cash value build up. But the other option is for you to do a lump sum down payment, or you just have a straight up paid up policy. Then you can start utilizing that cash value. The loan repayments is optional. The reason why it's optional is because the insurance company, when you're borrowing that loan, the insurance company is really not touching the cash value accumulated on the policy. What they are doing is they are going to give you a loan, but they are going to collateralize or use the cash value that you have in the policy as collateral, but they will give you a loan from the insurance company general fund, yeah, and they will charge you an interest on that loan that they give you, but it's very, very competitive. And given that you don't have to pay back the loan, there are no credit checks, nothing of that sort. But eventually, if you never paid the loan, what they will do is they will be able to pay your family a death benefit, but it will be reduced by the amount of the loan that you owe. So that is one area that a lot of people don't really take advantage of, and you find people are in so much debt, and if they have a life insurance policy, a permanent life insurance policy that has cash value, it would be far much better for you to take a loan from the insurance company, right, and use that to pay off your debt, or you can use that to do major purchases or pay credit cards off and all that good stuff. Okay, so once again, I just wanted to tell you about that today, and I will be coming back again soon to talk more about some of the topics that some of my clients have suggested that I talk about. So very good, thank you so much. And if you like this video, you can subscribe. You can also check out on YouTube. You can also check us out on our website, metrofinancial.com. So but please like, share, subscribe, and thank you so much, and may God continue blessing you.